How do dividends affect at-the-money options? Have you ever wondered how dividends can impact your options trading, especially when it comes to at-the-money options? Let's break it down in simple terms. At-the-money options are those where the strike price is very close to the current price of the stock. Dividends are payments that companies make to their shareholders, usually in cash. When a company pays a dividend, it reduces its assets, which often leads to a drop in the stock price. This drop typically occurs on the ex-dividend date, which is the date when new buyers of the stock will not receive the upcoming dividend. On this date, the stock price usually decreases by about the amount of the dividend. This change in stock price directly affects the intrinsic value of options, including at-the-money options. Let's look at call options first. Call options give you the right to buy the stock at a specific price. When a dividend is paid, the stock price drops. This can lower the value of call options because the stock price is now lower compared to the strike price. For at-the-money call options, this means they may move slightly out of the money or stay at the money but with less potential for profit. Now, what about put options? Put options give you the right to sell the stock at a specific price. When the stock price drops due to a dividend, put options generally increase in value. This is because the stock price moves further below the strike price. For at-the-money put options, the drop in stock price can push them into the money or increase their intrinsic value. Options pricing models, like the Black-Scholes model, take dividends into account. These models adjust the expected future stock price, which can lower call option premiums while raising put option premiums as the ex-dividend date approaches. The time value of at-the-money options may also be affected, but dividends usually have a smaller impact compared to other factors like changes in implied volatility or time decay. For traders, it is important to consider how dividends affect at-the-money options, especially around the ex-dividend date. If you hold American-style options, you might see early exercise of call options to capture the dividend. This can create assignment risks for option sellers. Understanding how dividends can impact your options strategy is essential to avoid unexpected losses or assignments. In summary, dividends cause the underlying stock price to drop on the ex-dividend date, which typically lowers the value of at-the-money call options and raises the value of at-the-money put options. Being aware of this dynamic is key to making informed decisions in options trading.